Welcome in our special guest this morning, Karan Bhagat, joining us, MD and CEO, IIFL Wealth and Asset Management. Karan, great to have you with us, and particularly get a sense of direction from you. Where are we headed? You sound fairly confident that this is the time to perhaps tap into some of those opportunities wherever we are seeing lower valuations and build one's portfolio. But how confident are you, Karan, that this recovery will come through and that we will see concrete signs of economic revival over the next couple of quarters or so?
Thank you. I think with every degree of certainty, it's impossible to say the exact time in which the recovery will happen. But I think it's fair to say that the recovery will happen. This too will pass. And as we've seen in the US markets, I think eventually valuations will play out. At round about a Nifty of 9,000, 9,100, I think we're relatively valued at close to around about 16.5, 17.5 times, which is close to the lower end of the valuation range. And we are also close to around about 2.3, 2.2 and 2.4 times Nifty on the book value multiple. I think in the longer term range for an investor, these are definitely levels you can come in at. Are these the lowest levels you can come in at? Extremely difficult to decide that. I think markets can head lower, but over the next 3 to 5 years, if you enter at these levels, definitely there is money to be made. However, these will definitely may not be the lowest levels possible. In terms of economic recovery itself, I think it's too early to decide. I think the biggest driver for economic recovery will be demand, consumption, demand revival and consumption. I think these are two things which we'll have to wait and see how they play out over the next 60 to 90 days specifically. From a business's perspective, obviously businesses which are dependent mostly on local demand and consumption are the ones which are going to most likely rebound first. Businesses which in turn are dependent on capital as an input and a raw material will take a little longer to come back again.
Karan, we'll come to the breakup of segments in a moment, but do you also find the market becoming increasingly polarized? When we're talking about valuations, it's again those handful of names and the larger cap names that are actually perhaps continuing to see buying. When it comes to the broader markets, there is still a lot of uncertainty, a lot of risk being associated with getting into some of those stocks. So what's the strategy that you're taking when you're looking at a bottom-up approach?
So I think about 2 or 3 things, right? So one, I think the big will become bigger. I think over the next 3 to 6 months, consolidation will be the key. It's extremely important while picking stocks or picking mutual funds that you're extremely cognizant of the fact that these times are times which are not extremely well understood by anybody, and therefore the probability of succeeding by investing in larger companies or the top 5 or 10 companies in every sector, you've definitely got a higher chance of success. It's also possible over the next 12 to 18 months as things recover, the bigger boys will end up with a much larger market share of a larger market 12 to 18 months down the line. It's also happening, as we've seen in the case of a lot of NBFCs and banks, that the quantum of capital available and the cost at which the capital is available, both are extremely different for small to mid-sized NBFCs as compared to mid to large-sized NBFCs. So obviously, if the raw material availability itself is at such polarized levels, effectively at some point or the other, it will reflect in the stock price. So I think polarization between sectors where capital is not a requirement to do business, and polarization where the size of the business or the parentage is allowing in easier access to raw material will result in consolidation, and therefore you will see money chase these businesses much more than going after smaller businesses.
Karan, so what is the feeler which you're getting from HNI investors? Especially when you see an episode like Franklin happen, it just makes you believe that even debt is not safe and equity returns have not been great. So What are HNI investors doing? Are they using the decline to increase allocation to equities, or are they of the view that right now it's time to hold back, let's go back to a liquid fund or FD, we will come back when we see signs of a sunrise, rather than trying to catch a falling knife?
No, so that's right. I think, Nikunj, it's fair to say that high net worth individuals have felt kind of a little nervous even about fixed income over the last year and a half, 2 years actually, not only driven by the Templeton episode, but even after the ILFS episode. Credit funds in specific have underperformed the market and ended up with returns of 3.5 to 4%. While it's true for credit funds, it's not necessarily true for the rest of the AAA and the sovereign market. Most of our clients would have close to 75 to 80%, if not 85%, of their fixed income allocation in AAA and sovereign paper. The stress there has actually been very, very little. In fact, over the last 6 to 8 weeks, the interest compression in these papers has been substantial. Credit funds itself, obviously, there was a systemic problem in the form of an asset liability mismatch also, as a larger number of investors went to redeem and mutual funds were unable to necessarily liquidate those papers to facilitate the redemption. I think investors are a little cagey. They will end up flocking a little more to tax-free bonds, more specifically AAA, quasi-sovereign and sovereign funds. For example, the Bharat Bond ETF, papers like HDB, HDFC, bonds, and some selective fixed deposits and tax-free bonds at around about 4.7, 4.8% will continue to be the flavor of the day. From an allocation perspective, I think investors have, over many, many years, I've seen them evolve and become extremely smart in their allocation. Broadly, I think it's fair to say that it seems as if 8.5 to 8,700 to around about 10,000, 10,200 is the new normal. And I think either south of 8.5 or 8,700 or north of 10,200 is where you really see a lot of our clients either coming back into equities below 8.5 or 8,700, or if for any reason the markets were to shoot up in the short term to 10,500 without a similar recovery in demand, I think we would end up seeing them lighten their position.
You know, you are an asset allocator, so I won't get into too much of valuations and too much into, you know, which companies are doing well, which companies are not doing well. For someone who's watching the show, or perhaps is your client, is confused right now because of the news, because of the fear, because of what is happening to the economy. So if someone has to, let's say, make an asset allocation for 6 months, 3 years, and 5 years beyond, what do you think would be the ideal allocation and the ideal mix according to you?
So, really difficult to necessarily make an allocation for 6 months, 3 years, or 5 years. I think most of our clients have their allocation divided into two parts. One is essentially what we call the kind of strategic allocation, and the other is the tactical allocation. The strategic allocations obviously driven by longer term needs, traits, behavioral aspects, ability to manage volatility, so on and so forth. Most of our clients today would be 60% in fixed income, 30 to 35% in equities, and potentially 5 to 10% in a combination of real estate, gold, and currency. The way the tactical adjustment in asset allocation essentially happens is a function of the movement outside the normal range of valuations. So for example, on the equity side, if you see valuations stretch below 17 times or beyond 20 times, we may potentially come down from 30, 35 times all the way to 30, 35%, all the way to 20%, or go up to 50%. As we speak today, we would be invested close to around about 35% into equities, 60% in fixed income, and 5% real estate. And as I said earlier, if Nifty was to drift further below 8,500, from there on, we'll progressively keep adding to equities till we reach 50%. And if it goes beyond 10,200, we keep reducing equities till it progressively reaches down to 20%. On the fixed income side, the larger split is essentially more in terms of credit quality. Credit quality essentially would imply the split between AAA, quasi-sovereign and sovereign and other credits. I think that's really where the split and asset allocation comes in. We strongly encourage clients to have at least 80 to 90% of their fixed income allocation in the first bucket, which is AAA, quasi-sovereign and sovereign, and fixed deposits included, and 10% effectively in everything else, which would include AA and some structured credit.
What is your sense on the savings or the surplus which HNI investors, let's say, were sitting on pre-COVID versus now? What I'm trying to understand from you, Karan, is that do you generally feel that there is going to be capital destruction within the HNI community, and that could have impact on both the fixed income as well as equity inflows?
No, I think I won't call it, I won't go to the extent of calling it capital destruction, but I think there will be multiple demands on an individual savings, right? So he's got three things to think about today, and therefore plan very, very differently, right? Number one, he has to plan for a scenario where businesses and demand takes much longer to recover, and therefore he may need to infuse capital into the business at different points in time, especially the if I can call it in some ways, the entrepreneurs of larger businesses may not be necessarily listed. Second, obviously, he's got a demand on potentially saying that there might be very large opportunities which might come out on account of dislocations in the market over the next 12 to 15 months. And thirdly, and most importantly, he wants to keep aside a pool of capital which kind of represents his safe bucket, given the hard work and the quantum of efforts he's made over the last 25, 30 years building his businesses. So I think what's happening is we're still not seeing capital destruction, but I think individuals want to be safe, they want to conserve capital, and most importantly, and rightly so, split their capital allocation into these three buckets and play out a scenario in their mind that if things were to not improve substantially or get delayed, do they have enough capital to provide for these three buckets?
Sure. Karan, I recall chatting with you right after the ILNFS crisis as well, and the view on financials was very different. But now, how is it that you're viewing the entire financials basket? We're seeing even the big five now get their coffers up and ready, keeping that powder dry. We've seen the Kotak QIP as well happen. There is reports of Axis as well raising about $1 billion. It's no more about all the financials now. It's just about the big five. What are you telling your clients? How should they be approaching financials, which was such a overowned space? And I guess that is what is spelling into the overselling as well that we're seeing play out right now in the sector.
So I think post ILFS, obviously there were a lot of concerns on the liability side for all financials. The entire commercial paper market, in some senses, post the ILFS episode, has got decimated, especially for the smaller NBFCs, and has therefore resulted in a much higher cost of borrowing, as the liability side has moved away from borrowing from mutual funds to banks and potentially raising debentures from individuals and other institutions. What we are facing today is a very, very confused estimate on what is the problem on the asset side. Obviously, there are NBFCs which are more on the secured side of lending, but then there are another whole set of NBFCs which have a large amount of exposure to SMEs, real estate, and so on and so forth. And today it's extremely difficult to be able to necessarily, with accuracy, estimate the probability of loss in some of these sectors. I think, therefore, you've kind of, when you look at your balance sheet, you've got a twin problem with a certain set of challenges on the liability side and potentially a much larger, potentially, we don't know today, potentially a much larger challenge on the asset side. And therefore, it is intelligent and to a small extent sensible to ensure that balance sheets are extremely well capitalized. The problem really is in the small to, in some cases, even the medium to large financials, where valuations have not necessarily sustained the last 2.5, 3 months of correction, it becomes extremely difficult to raise capital at current valuations also. Obviously, Kotak Bank, Axis, some of the names you mentioned, continue to be fairly well valued. Relatively, obviously, they are less valued than what they were 3 to 4 months back. But I think given the fact that they're still quoting at a potentially a 2.5, 3 times multiple to book, in the case of Kotak slightly more, it enables and gives the bank the ability to raise capital even in today's environments.
Sure. Karan, what are you telling your clients in terms of a contra bet, purely when it comes to equities? Many believe that manufacturing could be the next big ticket where India could win over China. Is that something that is a pocket of interest to you, or you think money could be made, maybe not in the near term, but maybe next 1 to 2 years?
So I think manufacturing, commodities, cyclicals end up being a little bit of a contra play. But sometimes you may not get it right because more often
I have a few more questions.
They tend to be cyclical. And as they tend to be cyclical, it's extremely difficult to make money because you need to get both sides of the cycle right. So typically, commodities, cyclicals, manufacturing would be a good contra play, especially at these valuations, but they would end up occupying less than 15 to 20% of the portfolio. From a longish contra play, I think from levels which are potentially 10 to 20% lower from here in terms of stocks, not in terms of the index itself, I think for a very long term, which is 3 to 5 years, the leading financials may become an extremely relevant play. And pharma and stocks based on domestic consumption as well as FMCG will obviously continue to rule the roost from a short-term demand and investor fancy over the next 6 to 12 months.
The expensive valuations on consumption are not a bother?
No, valuations are a bother, but as we've discussed earlier, I think the fact that there's a reason why valuations are not a bother, because there is a little bit of more ability to predict a potential demand revival. And obviously, you don't have the same problems on the asset side of the balance sheet like you have on the financials. So you have a cash surplus balance sheet, which enables you to live through a much more unpredictable time. So the premium you are paying in valuations is essentially for a clearer, more transparent, and a higher probabilistic event as compared to financials in the short term.
Fair enough. Karan, there's been a lot of news doing the rounds with select to certain blue chips making the most of this time, fundraising and what more. We're also now hearing, of course, of possible plans for the likes of a Reliance to list overseas and subsidiary. I'm not sure if you're going to comment on specific stocks, but in terms of some of the action that we've been seeing with some of these frontline names, anything that's caught your eye, or what does that indicate to you in terms of being able to command certain valuations, in terms of what it does, setting the tone for the future?
So I think one thing it indicates for sure is that for the right business at the right value, and in the right time. For example, Reliance specifically, without commenting much on it, is effectively is turning out to be a great technology play, which in some ways or the other is the time is apt and right. I think the broad indication which we get is if businesses are there, they have built a moat. Most importantly, in the case of Jio, obviously there's a moat which is built, and the business is not replicable easily. I think at the right value and the right time, there is enough capital which is available. So I think it's fair to say that if businesses are of the right size, they have the right customer segment, the right pricing, and they have the right moat, and run by good management. So I think there is enough capital available to go out and build businesses. And let's not forget, the best time to build and start new businesses end up being times like these, which are fairly unpredictable and not necessarily measurable in every aspect.
Fabulous. Karan, great speaking with you this morning.